Hey, welcome back. Today, we're going to talk about closed versus open-ended funds. And I realized I looked through a lot of our courses, our content, all this stuff. We allude to this a lot, but I don't actually have a specific video that goes through this. So here we are. We're going to talk about closed versus open-ended funds. This is crucial for launching your fund, for framing it out, all the stuff we talk about. This is a crucial piece of how you want to actually design your fund, how long investors are going to be committed their capital with you, how quickly they can get in and out of the investments, and really how you want to structure it. So down to the whiteboard here, the whiteboard of truth and justice is what we call it around here. Okay, so the two main styles here are called closed versus open. I want to walk you through both and why they would be beneficial for each. So let's first talk about close-ended funds. I'm going to use this timeline right here of 0 to 10 years. Okay, so inside of your fund, a lot of close-ended funds. This is venture capital. This is private equity. This is a lot of real estate funds are usually close-ended. And how it works is they say, hey, this fund is going to be 7 to 10 years long. And that's how long we want your money locked up. We have a lockup period. We're going to raise money for the first, let's call it 18 months. And we're going to do different closes and stuff. We talk about that, how to raise money, but we're going to raise money for 18 months. After 18 months, we're going to lock up this entire fund. We're going to then, or while that's being during that 18 months, you can still invest in stuff, but we're going to invest, maybe it's a venture capital company. We're going to invest into a lot of startup companies, tech, whatever it is. We're going to help those companies grow over the next until 5 years. We anticipate after about year 5, depending on where the company's at, we will either sell the company, we'll exit somehow, we'll IPO, or we'll somehow try to get out of this investment. We plan on being out of all of our investments by year 7. If the economy's down or something's bad, we can extend to year 10, but at least by year 10, all of your money will be returned to you. So typically in a close-ended fund, investors put money in at the beginning and they don't see a return or large returns until year probably 5, 6, or 7. That's the big money-making years. That's when you make a ton of money, is when you sell, right? When you IPO, that's what they're planning on. It's the same thing for private equity. They're buying up lots of big businesses. They're going to do whatever they do to them, their plan, and they're going to sell them after 5, 6, 7 years or somehow exit the property. Same thing is true with real estate. Now that's called a close-ended fund. You can see because it's closed, right? And it makes sense to do that because if you're in a private equity deal and one of your investors wants to get out in year 4, let's say it's your biggest investor and they want to pull out $100 million. Well, that doesn't work because for them to pull out, you would have to sell a portion of your fund, and it might be a bad time to sell. It might not be the right time to get out of that position, and it will hurt the entire fund. The reason they do close-ended funds and lock up your money is so that you are not forced to sell before you have to sell. Okay, and that's typically why venture capital, private equity, and real estate funds do this. So that is typically why close-ended funds are the way that they are, is because you don't have liquidity typically inside of these funds, which brings us down to open-ended funds right here. Bam, all the way down. So same time I got here, 0 to 10 years. But inside of an open-ended fund, investors can come in and out as they please. So typically you'll see this inside of maybe a hedge fund. Okay, you'll have investors, they put money in at the beginning and they hold for a little bit, and then, hey, I want to move out of that, and they can move out. They can put money in, investors can come in and move out. Usually an open-ended fund does not have a start or end date. They just start it, and its plans is to go on for the next 25, 30, 40 years. They're going to grow forever as long as they can stay in business, right? Now, an open-ended fund, there's a few nuances to it, and you can decide what you want to do. So my fund currently is an open-ended fund model. The way I structure it with my investors is I say, hey, investor, it's an open-ended fund. However, when you come in, you have to leave your money in for 1 year at least. There's a 1-year lockup period because at least give me a chance, right? Give me a chance. Give me 1 year to give you some good returns. I don't want you running away in 20 days because you didn't like how I was doing things. Okay, give me 1 year. After 1 year, I believe in my documents, it's a 60-day notice. So a 60-day written notice, and I can work your money out and whatever, and I can get you paid out if you want to move out of our fund. That's how it'll work. And you will come out at net asset value, NAV, of what the fund is worth at that point. Now, there's a lot of ways to price where people come in and out because just like a stock, if somebody gets in early versus if they came in later, the value of the shares inside the fund might change. There's a few different models you can use to go and evaluate your net asset value, your NAV. And I'm not going to talk about that in this video, how to calculate that, but that's what you'll do is you'll calculate your NAV, and that's where the price that someone can come in and out of a hedge fund. Now you can put up longer lockup periods. You could say mine is 1 year. You could do 2 years or 5 years, or you could even maybe do 10 years. That's kind of untraditional. I wouldn't see that very much, but you could do it. Again, you get to write the Bible. You get to write the LPA and PPM of your fund, which is awesome. But these are two main schools of thought. So again, close-ended funds, typically anywhere from 3 to 10 years. Lockup period, usually there's not a lot of liquidity. Inside of an open-ended fund, more liquidity, typically like a hedge fund, right? They can just sell a position, a large position of bonds or whatever they're holding. They can sell and get out and liquidate their investors. It's a lot harder for a private equity firm to sell Staples, the company, to get you your money out, right? So that's why you have these two models of closed and open-ended funds. And this is crucial to look through when you're in your step 2 of framing your fund. Framing this out. How do you want this to look? What's the timeline for investors? When can they expect to get returns? In an open-ended fund model, typically you'll see them pay out maybe every quarter, sometimes even every month, semi-annually, a year. A lot of closed-ended funds don't even give, they give very small paychecks, very small distributions to investors. But until year 5, 6, 7, that's when you get huge paychecks. That's when you really get paid. Open-ended funds typically are paying out more on a more consistent basis. Closed-ended funds are looking for that big paycheck, that big, pot of gold at the end of the rainbow type of stuff, Lucky Charm status up here on the closed-ended funds. But hopefully that makes sense a little bit to map things out, and you can decide what you want to do inside of your fund, closed versus open-ended funds. There's a new style of fund called rolling funds. I'll have another video on that as well. There's a couple other different ways, but these are the two main models that you can look at inside of your fund. Thank you guys so much. Let me know what you think of this video below, and let me know what you guys think. See you in the next episode. Bye.